The biggest advice, though, I would give to younger VCs, or at least earlier funds, would be patience. Would be, everyone that comes in and pitches any deal, they sound so good. They've worked on their pitch. It sounds exciting. They're pitching it well. It sounds awesome. Let's do it. And you got to get really good at turning down good deals and being patient and waiting for the great ones.
Welcome, everybody. I'm Mark Peter Davis, Managing Partner of Interplay Ventures. On this podcast, I interview innovators about their strategies, industries, and decisions. This week, I chat with Jed Katz, Managing Director at Javelin Venture Partners. Javelin is a premier VC firm that has invested in a ton of successful companies, including a bunch of unicorns, like Master Class and Thumbtack. This conversation's a bit special for me. Jed gave me my first break into VC back in 2006. He's been a longtime friend and mentor. He's a special dude, and I go so far as to thank him for all that he's done for me in the opening of my book. Though Jed might not like it, he is officially an OG venture capitalist and entrepreneur. Before helping to start Javelin over 12 years ago, he was a successful founder, navigating the craziness of the dot-com boom and bust, and eventually landing a $1 billion acquisition of his venture, Move.com. He's totally a great guy. During our conversation, we discussed how Javelin operates, the current state of the VC world, the political implications of social media, important lessons he's learned both as a VC and entrepreneur, and there's so much more. Enjoy. This episode is brought to you by Bowery Legal. Bowery Legal provides a complete range of legal services to high-growth companies. They do everything from formation, employment, partnership agreements, stock grants, corporate matters, and venture capital and debt financings. If you're interested in learning more, visit bowerylegal.com. Welcome, Jed.
Mark, it's damn good to see you. I don't get enough of you.
Wow. If only everyone said that. So I'm going to start this off by introducing you. So people have a little color. I'm sure I'm going to miss lots of goodies, but I'll give people a little color in your background so they know why we're talking. And then we'll dive in.
Great.
So Jed Katz is one of the managing directors at Javelin Venture Partners. For those who don't know Javelin, they are a San Francisco-based Series A focused venture capital fund with hundreds of millions under management. We'll get into that in a little bit. They've invested in a bunch of well-known companies. A couple you might know are Master Class and Thumbtack, and Jed's actually wearing his Thumbtack shirt today as they announced a huge mega round as a unicorn valuation. I have a particularly soft spot for Jed, which we'll probably talk about. He is one of the people who gave me my break into venture capital back in 2006. So he's been a material part of my career and my story. I actually thank him, I think, in the acknowledgments in my book. Before moving into VC, Jed was the co-founder and COO of Rent.net and Move.com, two connected companies, which happened during the real startup boom back at the turn of the century. And they were real estate sites, right? It's been a while, that not only went public, but ultimately were acquired by HomeStore for $1 billion. So he has successful entrepreneurial experience and a long track record as a VC. Jed, what did I miss?
Just one correction. We were actually taking Move.com public when the market fell apart. So we kept building it for a year and ultimately merged with Realtor.com about a year after that.
Got it. Okay, but for the folks listening, you've seen the journey and you experienced the boom. Something that's almost out of the psyche of the startup community, the 2000 era, which was the topic 10 years ago still. Gone now.
That's true. Look, that was half my career was building companies, and it was an exciting time. And a part of me certainly misses that. It was really fun to build something from scratch and manage a lot of people and do things that were never done before. Back when there were few experts on the internet, it was fun to be one.
All right. Well, after we cover Javelin, maybe we could spend a few minutes catching up on that. Some of the things you learned.
Cool.
So why don't we start in? Do you want to give us an overview of Javelin?
Happy to. Javelin is, it's 12 years old now, amazingly. We've done 5 funds, almost 100 investments, and we are really a late seed, early A investor. So we're writing checks from 1 to 5 million. I think our average is probably closer to 4 million, actually. We've gone as high as 10 in a pretty rare circumstance. And we like to be the first institutional cash in and the closest partner to a founder for a decade, for however long it takes for that company to become big and have a great exit. We're all former founders, so we tend to invest in things that we'd want to be building if we weren't investing. And have a lot of fun just helping founders figure things out along the way without the drama and distraction that sometimes comes with other investors. So we just problem solve and build and brainstorm and help recruit and help raise money and help make smart decisions from a strategic point of view. The whole crew's been together a long time, so we gel well here. The process is pretty efficient. We tend to act more like founders than we do like most VCs. And we're excited. We think the portfolio is really good. We think the relationship with our founders has been fantastic, and we're excited for the next decade.
That's great. Can you give us a little color on the investment strategy? You can get a little real. One of the challenges entrepreneurs face is all the websites look the same. But they're not the same. The firms aren't the same. The theses are different. What do you guys do? What do you look for? What do you invest in?
So I guess I could best characterize it as signal before traction. So sector is actually one of the last criteria we use. We're good at certain sectors. We do a lot of marketplaces and SaaS and some consumer and some healthcare IT, some fintech. But that's not our first criteria. We first look at the founders, and we tend to invest, again, signal before traction. When they've accomplished something. There's something there. There's the product that's been built. There's early usage of it. People are sharing it. They're liking it. They're becoming addicted to it. Or there's early customers who can get a feel for their sales cycle or their pricing or, how big this thing can get. But really it comes down to, do we see this amazing spark in this founder or the founding team, their ability to build something that's really hard to do and then will be really hard to compete with, their ability to recruit and raise money and see the forest and the trees, and have a great relationship with the people around them, have a ton of grit, and are a pleasure to work with, very intellectually honest. And then we look for businesses that really have an unfair advantage early, whether it's a kind of distribution cheat sheet or a way to get a customer base that no one's been able to do before, or a product that's really hard to build. Markets have to be in the billions. The moat has to be real, and we want to invest in companies that are not just going to be bought someday or be valued someday based on some multiple of revenue, but really are building much more strategic value than that, so that whoever were to ultimately acquire them, if that's the path they go down, has to have them, can't imagine their competitors having them, and probably can't do what they do if they didn't acquire it. We've invested in a wide range of companies. If you look at our portfolio, it's kind of all over the place. But the common theme is, these are businesses that are capital efficient, highly scalable, with founders we want to spend a decade working with. And that's obviously a two-way street. They have to really like the relationship with us and feel like they're getting a lot of value from us the whole decade.
So in VC, everyone knows there's a handful of different things people invest in, right? Some people invest in teams, markets, products, barriers. That list sounds like you want it all. What would you say is not necessarily, is that the answer? When you look at a company, will you, if the founder's incredible, but it's on the come, is that a deal for you? Or if you kind of have a gun to your head and have to make some tough choices, what's the most important?
So you never get it all. Or maybe phrased differently, you don't have a crystal ball. So you don't know if you can get it all or not. You see some of it. You see signal for some of it that it can develop, or that future innovation will likely happen. So whatever the core product is today will expand into a bigger core product or additional products. And it's hard. I mean, I think at the end of the day, the founding team is the most important. I think some of our biggest mistakes in the past were where we knew the founders were winners, but couldn't convince ourselves on the business because it didn't not that it didn't check one of the boxes. It actively was against one of our core philosophies, but we still should have done it because the founder was so damn good and would grow and learn and adapt and build something amazing through the years. And so founders definitely come first. There's tenets we don't like to violate, and so we're probably more right than wrong when we walk away from something because it broke a key rule of ours. And I think the best example of that is intellectual honesty, right? If we are talking with somebody over a period of a couple of weeks as we're getting to know them in the business, and whatever they're saying is coming across as not valid, or they're kind of making it up as they go, and they're not saying when they don't know something, they're just trying to fake it, that'll come across, and that's a real turnoff for us. So I think that's served us well. But again, there's no crystal ball. We tend to go very much with our hearts at the end of the day on if we want to spend the next decade building this business, and at least one of us has to be banging their fist on the table. There has to be kind of an emotional component to this, where they really have to do this deal, and we tend to do those deals, and we tend to walk away from the deals where one of us is banging their fist on the table, saying we are not backing that founder for whatever reason. Those have been the best ones for us.
What are some of the other tenets you referenced? Do you have a list of like a 10 commandments that you guys follow?
We don't. We have a whole list of criteria like that. I wouldn't label it the 10 commandments, but the just the again, it's kind of the early signal we're able to detect. So their ability to get people to join them early is a big one, right? Will people bet their careers on this idea and this founding team before there's cash in the bank, before you have your first customers, before anything? Have you convinced others they want to go on this journey, that they should go on this journey with you, right? That's a big one. There's easy things to check off, right? If the market size is not in the billions, it's not something we're going to do, right? If scalability isn't really possible here, there's just too many moving parts and there's going to be too much friction, we'll walk away. We love to invest in things where it's possible to win the war before you fight the battles.
Mm-hmm.
And so, I think you mentioned Master Class before.
Yeah,
that's a great example of that.
Why does that match that criteria? Most people don't know the history and strategy there.
Yeah.
How did they win before they started?
So the bet at the time was, we invested before they had actually released their first class, but we saw the film, we saw the end production of the first class before they launched it. And it was beautiful, right? Hollywood level production. It was actually the James Patterson class that we saw. And the bet was that if they could get enough of these masters, usually celebrities, early to film these classes and release them, as the library would start to grow, it would become a thing that the rest of the A+ celebrities and masters out there would want to be a part of for legacy, for brand. They want to be known as the best of the best. And if you can get that flywheel going, it's going to be incredibly hard to compete with. And so really the trick was just getting the flywheel going. Can you get those early celebrities to do it and make the production value so high that the rest of them want to do it? If you can do that, it's going to be, your moat is going to be giant. And, all the other criteria was hit here. We love the founder, such a good human, so fun to brainstorm with, so willing to both take and give feedback, and kind of endearing, I guess is a good word, as an entrepreneur. I mean, he was able early on to convince the initial celebrities to film classes, which was amazing to us because it hadn't even launched yet.
So that was your signal, is that the celebrities were saying yes.
That was one of the key signals. We loved the model. The quality was great. We thought there would be one winner here. We thought that if you can become the place where you can learn from the best of the best, being a second place, copy of this was going to be almost impossible. And that was the bet.
It sounds like you were pretty right on that one. Hey, why pick your firm? You talk about building a company with the entrepreneur, and I like that language because it's very true to you, having known you for so long. It sounds a lot like you're picking co-founders. Now, you happen to be a capital partner at this stage in your career, but you as a serial entrepreneur, it sounds like you're just kind of serially going through launching companies again.
So you're certainly choosing. Go ahead.
Yeah, why pick your firm? Why do they choose Javelin over everybody else?
So you're certainly choosing partners. I wouldn't call them co-founders because the companies are theirs, right? It's very important to us that it is your company. We're going to give you lots of advice and brainstorm with you, but these are your calls. It's your company you're building, but we're going to be your partner, and we want you to have the same good relationship with us a decade from now as you did when we first invested. I think you choose us because we have a lot of empathy for what you're going through, the ups and downs, and just the pure difficulty of building a highly scalable startup. It is very, very hard, and there are constant challenges that you need to work through and talk through. Constant need to recruit great people, raise more money, do complicated biz dev deals, etc. And I think you choose us because we've been there. You can call any of our founders, whether the company has worked out really well or not, and they should say the same thing about us, which we've been a great partner from start to finish. I think the culture of Javelin is just really just how can we help you thrive here? I'll end this segment with we really try to avoid drama and distraction, and that includes guiding you on other investors that are going to come in after us. So who's ever going to lead the Series B, C, D, whatever. And so, we will give you a lot of, now 12 years of wisdom on who might be a great other partner to bring in down the road, who's going to be super helpful, give you advice based on context, and also be super friendly and fun to work with.
That's a big deal because I know you guys take board seats, right?
Almost always.
Almost always. And it's very hard, I find, for some VCs to really maintain strong and healthy relationships with founders when they're on the board in particular, because it creates tensions, challenges, complications. What has helped you guys, and maybe some advice for other VCs and entrepreneurs listening, to kind of keep the peace and stay human and keep those healthy relationships while you're in the pressure cooker of a boardroom?
I think there's an attitude that we're in this together, that the challenges that come up are just problems that need to be solved. It's, shouldn't be anything personal. We should be able to give each other feedback along the way and then go out and get a beer afterwards. And if any friction comes up, we'd like to deal with it immediately in a way that keeps everything super friendly. It's crucial. I think there's a lot of investors out there that they kind of have the attitude that the entrepreneur works for them and they can boss them around a lot. And when we see that, it's such a turnoff to us as a potential co-investor. I can only imagine what the entrepreneur is going through. And so we try to be kind of the opposite of that. And there are times when entrepreneurs do something that is frustrating to us. Of course, it happens all the time. We're all human, and we'll just talk it out and try to give advice and try to make sure there's lessons learned for the future. But we will never do it in a way that is us coming down hard on them. We really try to avoid any situation like that.
So your firm's a little unique, and I know some stuff that I think will be interesting for other VCs to learn about. A lot of firms, the natural cadence of development is maybe their first fund. Sometimes it's a lot of small checks from friends. Sometimes it's a rich uncle, that type of scenario. The second fund, they go out and they get a diversified LP base. And that's usually a pretty gauntlet cycle because you got to convince 50 or 100 people to trust you with their money, which is hard, which is really hard. And then there's just growth in institutions that kind of continuously back you. Now, if I'm not mistaken, Javelin started out for a first cycle of funds, a number of them, with a single LP. And those were large funds. How did that
small.
change?
It was a small, kind of extended family office.
Right. How did that change the dynamic for the firm and building? What did you learn from that, or would you recommend that to other folks? What do you think?
Well, yes. I mean, I think it. It's hard to do, but it allowed us to focus almost 100% of our time on finding and backing companies and helping them succeed. And fundraising can be all-encompassing. It can take so many hours, and so that was a huge advantage for us over the years. And I think it was a big advantage to the LPs as well, because the firm they backed were able to spend all their time doing their job.
Right.
And Obviously there's risk that's associated with that because if your LP base is less diversified, you better make sure you're keeping them happy along the way.
Right.
So, but honestly, it's the same risk as having a group of LPs, right? Because they're all going to look at it the same way. Are the returns there? Are they happy with the companies you're backing and with the way Javelin is growing as a firm? And luckily, it's worked out well for us.
So you guys have been running at this for 12 years, and I'd say you've had a hell of a lot of success. What were the biggest challenges you faced for other would-be venture capitalists listening? Maybe something you learned about building the VC business. People always talk about entrepreneurs and VCs, but most VCs kind of are entrepreneurs. They're building a firm. It's a company.
Every year I say, well, you don't get good at this job until, you've been doing it 5 years or 10 years or now 12 years. It's like every year you learn to pattern match a little better than the year before. Right. And you learn, your network expands. You learn, who are good debt partners, who are good Series B and C and D partners, who to avoid, what recruiting infrastructure should you help set up, and who's a great type of VP of engineering and who isn't. You learn all these things after doing it for so long that you didn't know in the beginning. And so in the beginning, you're really hoping to just invest in great companies and help any way you can. But, the amount you're able to help will only increase over time. The biggest advice, though, I would give to younger VCs or at least earlier funds would be patience. Would be, everyone that comes in and pitches any deal, they sound so good. They've worked on their pitch. It sounds exciting. They're pitching it well. It sounds awesome. Let's do it. And you got to get really good at turning down good deals and being patient and waiting for the great ones. And it's hard to do at first because until you've seen kind of thousands of deals come through, you don't really know early on the difference between good and great. It takes time. And so to the extent that you have a lot of patience early on, save your capital and have it ready for when that deal comes through that just blows your mind, that's the best thing you can possibly do early on.
That's great advice. Let's flip over to your entrepreneurial journey. Could you give a very quick, high-level recap of your story? I know you started your first entrepreneurial journey at business school, right? While you were at Berkeley?
Yeah, I was really fortunate to go to Berkeley for business school at a time when the web was really just beginning. So this was 94 when I entered, and I literally got my first email account when I started business school, and 2 months later started RentNet. And I just learned about the internet. I had just learned what the hell HTML was and started learning how to code in HTML 1.0. And my partner and I started RentNet because we thought that this was a great use of the internet. Right, you're always looking for a place to live, sometimes from a different city or state, and it's just really hard to do long distance. So, what if you could look at photos and floor plans, and ultimately virtual walkthroughs, and search on, narrow it down to a good apartment for you? And so we built it, and it became clear in under a year that there was something here. This was going to catch fire, and so we started hiring people and hiring reps around the country to visit all the large apartment buildings and inside reps. But the biggest thing we did, or I did at the time, was benefit from using RentNet as the focus of all my projects in business school. So I had teams of consultants, basically free consultants, helping me work through some of the stuff as we tried to build this. Almost dropped out of school, but the dean convinced me to stay in, actually, and was able to get it done. RentNet ultimately evolved into Move.com, where Move.com added homes and relocation services and mortgages and all that, and became one of the two big real estate sites at the time, the other one being Realtor.com. And again, we built that, honestly, it a little too fast, and added people. We were about 160 people when we turned it into Move.com, and it grew to 350 in under a year. And that's just way too fast. And so there were cultural effects, but we were also trying to take the company public at the same time. And my head was just spinning trying to get everything done. And then in what was this was March of 2000 when the market fell apart, and we were literally on our roadshow. And so we just kept building the business, which ended up being a really good thing for us because it was just the business worked well.
Right, you had real fundamentals, which is not common at the time for everything going public.
And so we were able to do a pretty big merger with Realtor.com in February of 2001, about a year after the crash.
That was about $1 billion transaction, right?
Right.
That's right. So what are some things you learned? And, because you kind of are old school at this point, entrepreneur, got some OG entrepreneurship going on here. There's probably some lessons. I like that phrase. I don't know you're like it either, but it's true. There's probably some lessons you learned that were a different way of doing business back at the time that maybe apply today but aren't used as commonly. Customer acquisition, anything jump to mind that you think was like a particularly
honestly, the tactics are different, folks? but the fundamentals will always be the same. I think as an example, we were so aggressive about sales and building our brand and being in front of the potential customer so often that when the salesperson came by to do the sale, they already heard about us, knew about us, knew their competitors were using us, and honestly, it was like almost 100% hit rate for our salespeople. And so
how did you create that awareness? How did you suffocate people with information?
At the time, it was a lot of, believe it or not, mailings, and but really higher end ones. And it was a lot of sales visits and phone calls. It was ads in all the trades. It was building. It was a lot of PR, right, just to get the industry talking about us. And really, there was a bottoms up approach too. So we would get the leasing agents to be aware and kind of move it up the chain, so that the management companies that owned or managed 200 or 300 or 400 buildings would hear about it from so many of their leasing agents that by the time we pitched them at the top level, they were already convinced.
Right. Had any thoughts on the direct mailing? I feel like that's fallen out of most people's toolkit.
Yeah.
I heard a stat. I don't know if it's true. 60% of venture capital dollars raised are dumped into social media ads at this point. I'm sure that's wrong, but I know it's a lot.
Well, look, if you're going straight to consumer,
is direct mailing no longer relevant? Is there an angle there? Is it underutilized and maybe higher ROI?
Amazingly, it's still a huge industry. But look, if you're going to the consumer direct, then you're going to find a much better ROI online, without a doubt. And there's lots of ways to do it. In fact, one of the best ways right now is actually OTT. That's where we're getting great returns for a number of our companies.
Describe that.
That's just it's more trackable kind of video ads on video content that you're streaming, as opposed to just
Is there a network or place you like to buy those? Where you guys shopping?
That's more of a question for our portfolio companies on who they're specifically using to buy those. So I can't really advise you there.
Okay.
But if you're going after businesses, and especially if you know who the decision maker is, and especially if it's SMBs, sometimes it's actually harder to get them through whatever online thing they're doing, because they're it just gets noisy, right? They get so many emails and so many ads in front of them every day that if you can do something different, that's more of a thing that pops out at them for some reason. Again, it's also a longer term branding exercise. So if you can do this several times, so by the time someone's trying to make the sale, it's in their mind. It might be a combination of offline and online. But I wouldn't do offline things that are just kind of cheap and flimsy and something they're just going to throw away immediately. If it doesn't pop out, it's not going to be worth any money at all.
So you were COO of that company, and I've always known you to be very operational in the way you think and function. Is there a particular advice you would give to the entrepreneurs listening who are in the COO seat? Everyone's talking to the CEOs. What does a COO need to hear to kick butt?
The COO, for the most part, is running the company. The CEO has so many other responsibilities, in terms of the top recruiting and fundraising and PR and the strategic initiatives. The COO is doing kind of the day-to-day tactical, making it happen. And they're going to need great lieutenants. They're going to need a lot of support. They're going to need great resources. They should have mentors of other COOs that they get together with and kind of compare notes. They need to be very detail-oriented and tireless, and they have to build fantastic tools to track everything that's going on in their business so that software helps them be a lot more efficient. And I think you mentioned Thumbtack earlier. I mean, Thumbtack in particular is so good at building tools that show them how every aspect of their business is working and what needs attention right now. And if you think about Thumbtack, it's actually not one big marketplace. It's a million little marketplaces. So each category and each geography is its own marketplace. And to be able to study what's happening in a million little marketplaces and make adjustments on the demand or supply side in real time, and then build the future product the right way to improve everything. It's an immense undertaking, and so the COO there is a guy named Jeff Grant, who's amazing, and we spend a lot of time together just brainstorming on things like that. Every company, especially as it gets to scale, needs a fantastic person that's watching all of that in real time and just operationally excellent. Whatever the title is, whether they're COO or something else. Go ahead.
There's an interesting derivative point in that, right? A lot of early entrepreneurs think a lot about building a product, but they don't realize that every product is two products. You've got the customer-facing product, and then you've got the internal product, which is your admin dashboards, the functions, so you can adjust things in customer service. Anything you've seen, is it any wisdom on the internal product? Is it build more analytics early? Is that something you took from Thumbtack?
Yeah, I mean, they are extremely data-centric, so they build a lot of tools and they track everything. I think, a lot of our companies have gotten really, really good at that. And I guess the advice is, you want to study as much as possible, but you want to make sure the stuff you're studying is the most relevant stuff. And that the things that are alerting you and the things you're focusing your time on and prioritizing are the right things. Because you can go crazy on this and you can study every last little thing forever, and all you're doing is analyzing all the time. So you have to build tools in a way that that really bring the high priority things up to the top and paint a clear picture, not just to the executive team, but really to the whole company, on what's really happening with the business, so that everyone understands why you're prioritizing certain things, certain ways.
So you've taken a company public. You mentioned earlier your roadshow for Move.com.
Well, we were about to take it public when
you're in your process.
Yep.
And so you had experience kind of going through that dynamic, and not a lot of entrepreneurs do. Not a lot of folks get to that point where they see that on the inside. Also, the game's changed a lot. I mean, that was better part of 20 years ago. How have you seen what's changed on the IPO process for companies? How do you think about that?
So we have a slew of companies that are gearing up for this over the next 6 to 24 months, and it's intense. I mean, you got to be really organized. Your board has to be the right board for this, and a diverse board is super important. The business has to be at a very predictable place, so that there are no big surprises and that people know how to analyze it. You tell a clean story of how to think about the business, how to look at the right metrics, and you hit what you say you're going to hit. The biggest difference, though, is the access to capital as a private company is so immense, and especially such large amounts of money, that companies are waiting much, much longer before they go public. It used to be, if you had 50 million in revenue, you could go public. And now, companies don't even think about it until they're doing over 200 million. And a lot of companies are going when they're at $1 billion. And it's just a different animal. At that point, you also have to be able to attract, much bigger, longer term investors. And obviously tell a much bigger story of what this business is going to become, in the next 5 or 10 years. And why the market opportunity is still so much bigger than what you've created at this point. But the biggest difference is the private capital. It's pretty amazing, actually.
I wonder what the chicken and egg there on the private capital side is. Barry Silbert, who runs Digital Currency Group, used to run a company called Second Market. I think it was bought by the NYSE. It's certainly used by them. And I remember he gave a talk once, and he said that the average time to hit an IPO around the boom was 4 years. And I actually think that's where the 4-year vesting cycle comes for employees. But it's shifted to 9 years now.
Yep.
My understanding at the time was what delayed it was the legislation, the regulations the government put in after the crash in 2001. And I wonder if did the private capital came in after companies couldn't go public, right? Wasn't there like this, there's very tenuous valley where companies would be, IPO scale of old, but not be able to go public because the cost and the process was too big. And so they were looking for capital and raising rounds that were subscale for where they were.
Yeah.
And then we see things like Tiger and SoftBank stepping in with bigger books.
I think that's how it started, right? That's certainly, it was really hard to go public, right? So that's how the demand side of it certainly started, right? The companies needed to find cash and be able to get their ducks much more aligned before they were ready to go public. With that said, the investors discovered it's, when you're buying companies at the IPO, it's limited. You're getting an inflated, or at least a higher price than you wanted to pay for it, perhaps. And if you could get in earlier at a discount to that, but you still knew you wanted to be hold the shares after they were public, why not aggressively find out a way to do that and figure out if you could push your way into these companies a year before or 6 months before they go public?
Mm-hmm.
If you're going to buy their stock anyways, it's almost free money for you. So, they all kind of recognized this and started approaching the companies, and the companies reacted rationally and said, "Hey, yes, higher valuation. I can build more. I can be better prepared to be a public company, and be a stronger company with a stronger balance sheet. And I don't have to rush it so much. It'll be less about my need for capital when I do it, and more about liquidity, being able to make acquisitions, having a currency, et cetera, and kind of a longer-term investor base." Made sense for both parties. I get it. It's just hard for earlier stage investors like us. Or I shouldn't say it's hard. I say we're just in it longer, right? So like you said, we used to be in a company for 5 to 7 years, and now it's 7 to 10 years. But
Right.
the outcomes are going to be bigger. So it ends up making a lot of sense in the long run for everybody.
And LPs have adapted to that. So it feels like the whole market's recalibrated for the new
I think
model.
some LPs have adapted to that. I think LPs love distributions, right? They love to know that that your early investments worked, they got bought, they went public, there's a big check coming their way, they can reallocate to other things, et cetera. And if things are going to take 3 or 4 years longer, but be a much bigger check when it does come, that's great when it does come. But in the 3 or 4 years they're waiting for it, they can grow impatient.
Mm-hmm.
So that's going to happen. You're going to see a lot of that. And then I think over time, the ROI is going to be clearer for everybody, and they're going to be happy with the outcome.
Let's switch gears for a second, because you have another interesting dimension as I've watched your career over the years. I know you've been involved with political campaigns in the past. If I'm not mistaken, you played a small, role, but were involved in the Obama campaign a while ago.
Yeah.
What do you make of this kind of ties into the current political dynamic. What do you make of the role of social media in society? And I ask you, I think, in particular, because you sit at the nexus of venture capital. So you're kind of on the business side of tech. You're looking at the political side. You're investing in it. You're affected by it. Yeah. We've all watched this social dilemma recently. What's your read on what's happening?
It's hard to answer that question with just one hat on, right? So let me just take the VC hat off for a second and just put my Jed Katz hat on. It's scary what's happening out there. It's scary how fast misinformation can travel and how many more times it gets shared than facts, and how quickly people believe misinformation and how dangerous it is. And it literally keeps me up at night when you think about some of the things, people that you would otherwise think are extremely smart people are believing, that are so clearly proven wrong. and I think the social media companies, the big ones, have not done nearly enough. If anything, it's the opposite. They are aggressively pushing clear misinformation because it just gets more clicks and more minutes, and they make more money. And they're causing these things to become worse than they need to be. And so, look, putting my VC hat back on, I would love to find startups that can really innovate a clear solution to these things without causing some big problem with free speech, but with just figuring out a way to win, figuring out a way to make sure facts are honored and shared more than misinformation is, and in a way that the business models still work. So there's no incentive to shut that down. It's really tricky and hard. And
what would you do if you were either running one of the big social media companies or regulating this? What would be a potential solution here?
It's a tough one because they're so driven by what makes the most money, which makes it really hard in the short term. I remember, when they first started solving the reputational things on search engines, where somebody would put something bad up about someone, and it would just be there, and they couldn't do anything about it. And then they realized if they put up a ton of good stuff about them, the bad stuff goes way to the bottom eventually, and maybe that works at least for some amount of time. Companies like I don't remember, was it Reputation.com or one of them? Kind
There's
of
a number
started
of
off
these out there, right?
Yeah, and and that was at least a tactic that that worked. So I don't know. I don't know if it's just figuring out a way to get the facts to jump to the top more. But it's the same thing with a lot of journalists too, that will use headlines that result in more clicks, and it helps the journalists promote themselves and the article get read more. But the headline is just completely false or paints a picture that is very misleading. That happens all the time. So I think social media companies and journalists together have to kind of bring a little more honor to what they do, and it's going to cost them a little bit of money. And so maybe there's great entrepreneurs out there that can help make sure it either costs them less money or actually makes them money. But ultimately, there's going to have to be a recognition that there's that making money is not the only thing that's important because of the damage some of the other stuff is doing to our society here.
I feel like this has been, I'm a little bit of a history nerd, but misinformation has been around for centuries. It's as old as it gets.
Big difference now, though, how fast it can travel.
But the difference is right now, it's a tidal wave when you say the wrong thing. It's interesting to see if the government figures out how to legislate this. Because usually when there's bad behavior in companies in our type of society, we're dependent on the government to actually put bumper rails up. And they haven't done it yet, but I know they're trying. They're at least talking about stuff. And I'm anxious because I don't know that a lot of our legislators understand the underlying issues. If you watch some of these hearings, it's terrifying. They don't use the tools they're trying to regulate.
I don't know if the federal government can do this. I don't know if this is a problem they can solve. I think...
who else is going to solve it? These are multinationals.
I'm hoping entrepreneurs solve it. Right? I think everyone knows it's a big problem. And when there are big problems, founders come out and create solutions that you and I couldn't have dreamed of, but can catch fire. And I'm hoping that happens, and I'm hoping it happens in a way where the big, social media players and even journalists notice, and it changes their behavior. And we've looked at things along the way that were really clever, but we're going to have a really hard time scaling. And so what I'd really like to discover is a company that can help solve these problems and do it in a scalable way.
So the government is right now talking about putting legislation in place to try to tackle some antitrust level for big tech. They're trying to limit conflicts of interest, promoting their own products, making sure the companies are a little bit more interoperable. But they're also trying to put a bit of friction in around acquisitions, which is an interesting byproduct. I guess they're trying to reduce consolidation, What do you
It comes
make
down to
of
monopoly power, right? And what happens when you have monopoly power or something close to monopoly power. And
Yeah.
I don't like them limiting smaller acquisitions because it creates too much friction. You can kill businesses along the way if you do that. I think that's bad. We actually, when we were doing the Move.com merger with Realtor.com, we had to go through HSR approval, and what should have been a 30-day exercise turned into an 8-month exercise because they thought we were
Wow.
going to be a monopoly in real estate, which is insane. 8 months. And so I can only imagine what some of the bigger companies are going through, even with some smaller acquisitions. And so I think that can get out of hand quickly. But the theme is the right theme, which is if monopolies or companies that are close to being monopolies start abusing their power in a way that is really hurting free market, then at some point they're too big and there needs to be some controls. And you do see that with some of the big companies that put their own services ahead of people at other businesses that aren't owned by them in a way that gives them way too much advantage. You also see it in we'll take Google as an example. Amazing company, does a lot of amazing things. But if they change their search algorithm in a way that, for whatever reason, wasn't fair, it didn't analyze a certain thing correctly, or the people that made that decision, and they changed their algorithm to kind of ding somebody, that company loses all their SEO power. And they don't even know who to call. They don't know how to, reach out and appeal and provide facts and try to, get somebody to talk to kind of overturn that algorithm change. And it takes forever to figure it out. And I think that's pretty terrible because that can kill businesses overnight. And sometimes we've discovered over the last decade those decisions can be made, kind of quickly and kind of on wrong information, and cause a lot of damage. And eventually, when you do get to the right person, it can be overturned and fixed. But there's a lot of money lost in the meantime. And it's just a scary position to be in, that you can kind of flip a switch and really hurt a business without having a real place for that company to be heard and talk it out first.
If we go back into history, when we had the trusts, super large companies, the monopolies develop, oligopolies develop, one of the major tools wasn't just regulation. They broke them up. They sliced divisions into separate businesses. Do you think there's a play here for that taking the big 5 companies and breaking them into big 100, or medium 100 would be an appropriate move? Or do you think that's more damage than benefit?
I'd like to see that not be necessary. So I'd like to see the companies behave in a way where no one's calling for that. That's better. Are they going to get to a size where some version of that, where some division is necessary because it's just too much power? They probably will get there. I don't know if that's in the next couple years or a couple decades, but it would be nice if that wasn't necessary.
Jed, this has been great. Let me ask you one kind of final question here as we get into this. You've had a long run. You've done the entrepreneur thing. You've done the venture thing. And you are unfortunately an OG at this point. What's the next 10 years got in hold for you?
I don't know. I still feel young. We have such a great team of different aged people here, and it keeps me young. Startups keep me young. Working with founders keep you young. Whenever I feel like I'm too up there to properly analyze something, I call my niece, who's 16, and she helps make us make the right decisions here.
Yeah.
This job is so fun. I don't know. I mean, I'll be doing this a while longer because, man, there's never a boring day in this job, is there? Do you ever get bored? I can't remember ever being bored. I love it.
Jed, thank you for everything. Thanks for being on the show today.
This is great. Always a pleasure to talk to you. And next time we'll have to get into how we originally met, because it's still one of my favorite stories. But we'll talk about that next time.
I carefully carved that out of the conversation today, if you didn't notice. Anyway, thanks for being here.
All right. Thanks, Mark. Bye.
All right. That was awesome. Huge thanks to Jed for joining me on the pod today. I love catching up with him as always, and I really appreciate hearing his take on what's happening in the world today. If you like what you heard, please hook us up with a like or a 5-star review, and feel free to share with a friend. You can find me on Twitter at MPD, and to hear more of my conversations with innovators, subscribe on YouTube, Facebook, or any major podcast platform. Just search for Innovation with Mark Peter Davis.